Good afternoon. This is the Chorus Call conference operator. Welcome, and thank you for joining the Amplifon fourth quarter and full year 2025 results conference call. As a reminder, all participants are in listen-only mode. After the presentation, there will be an opportunity to ask questions. Should anyone need assistance during the conference call, they may signal an operator by pressing star and zero on their telephone. At this time, I would like to turn the conference over to Ms. Francesca Rambaudi, Investor Relations and Sustainability Senior Director of Amplifon. Please go ahead, madam.
Thank you. Good afternoon, and welcome to Amplifon's conference call on fourth quarter and full year 2025 results. Before we start, few logistic comments. Earlier, we issued a press release related to our results, and this presentation is posted on our website in the Investors section. The call can be accessed also via webcast, and dial-in details are on Amplifon's website as well as on our press release. I have to bring your attention to the disclaimer on slide 2, as some of the statements made during this call may be considered forward-looking statements. With that, I'm now pleased to turn the call over to Amplifon CEO, Enrico Vita.
Thank you, Francesca. Good afternoon, everyone, and thank you for joining us. Let me begin with a few remarks on the year that just ended, which was without doubt characterized by market growth below the historical trend. However, we are convinced that this was primarily driven by the well-known geopolitical and macroeconomic factors which weighed on consumer confidence. As you know, we are also convinced that this does not reflect any structural change in our sector. In the United States, market growth was significantly below the levels we have experienced in recent past. This was mainly due to a significant decrease in the managed care channel, primarily following the reduction of hearing benefits offered by major insurance providers. Europe also developed more slowly than we had initially anticipated, with the only exception of France in terms of volume. In Q4, the global demand was likewise below historical levels. We estimate it to have been only slightly positive, 1-2%, largely reflecting, in particular, the softer U.S. environment. That said, we do not see demand fading away. Quite the opposite, we believe a degree of pent-up demand is being built, which should gradually materialize over time, although the exact timing is not easy to predict, depending on external factors. That's also why we expect a better environment in 2026, but I will return to this point at the end of the presentation. In Q4, we continued to outperform the market in most of our individual key countries, including, for example, Italy, the United States, Australia, France, and some others. In the quarter, our sales increased by 1.4% at constant exchange rate, while foreign exchange was a significant headwind of more than 3%. On the positive note, I would like to highlight that we returned to positive organic growth across all the 3 regions, and that the profitability trend also improved compared to the first 9 months. As you know, to structurally and meaningfully enhance our profitability, at the beginning of the year, we proactively and decisively launched the Fit for Growth plan, designed to best position the group for 2026 and beyond. So let's go to the next chart for a more detailed update on this. Fit for Growth is progressing very well and is currently tracking ahead of our initial plan, at the high end of our target range of 150 to 200 basis points of adjusted EBITDA margin improvement by 2027. I can also anticipate you that we expect to see some tangible results of our work already in this first part of 2026. In 2025, we closed or consolidated approximately 160 non-performing clinics across 10 countries, while implementing the related headcount efficiencies. These actions are meaningfully improving the overall efficiency and quality of our sales network. As of today, we have also identified additional efficiency and optimization opportunities for 2026, as you can see in the chart. Additionally, we have implemented a series of back-office optimization initiatives, leading to an overall efficiency of approximately 100 headcounts during 2025, with further opportunities now identified for 2026. Moreover, we delivered a significant 30 million reduction in CapEx in 2025 compared to 2024, driven by rigorous prioritization of high return projects while fully preserving strategic investments. Additionally, we are targeting a further reduction in 2026, reflecting the completion of some important transformative IT programs of the last years. Finally, we conducted a comprehensive strategic review of the attractiveness of all our business segments and related Amplifon competitive positioning. As part of this portfolio review, on March 2nd, we completed the divestiture of our loss-making business in the U.K. In addition, a managed care contract in the United States was terminated due to the anticipated structural margin compression in a context of decreasing volumes. Gabriele will provide further details on both profitability drivers in the next session. Finally, during the first quarter of 2025, as you know, we significantly rationalized our non-strategic wholesale operations in China. As already shared, these actions are aiming at sharpening our focus on core business segments and reallocating capital towards the group's highest potential profit-accretive growth opportunities. Considering the progress achieved and the additional opportunities identified, the Fit for Growth plan now targets an adjusted EBITDA margin run rate improvement at the upper end of the previously communicated 150-200 basis points range by 2027. Importantly, the expected non-recurring cash costs to implement the plan are now expected at approximately 25 million in total, compared to the 35 million initially anticipated. These costs will be incurred between 25 and 26, of which circa 9 million had already been recognized in 2025. With that, I will now hand over to Gabriele, who will walk you through our performance in more detail.
Thanks, Enrico, and good afternoon to everybody. Turning to chart number 6, we can appreciate more in detail the two latest developments within the portfolio optimization stream of Fit for Growth. Firstly, on March 2nd, following a comprehensive review of our business segments, we completed the sales of our U.K. business, which included a network of approximately 100 direct clinics across England and Wales, and a workforce of around 260 employees. It generated a revenue of 33 million euros in 2025, and, as you know, was very dilutive to the group's financials. Consequently, the divestment is expected to positively contribute to Amplifon Group's EBITDA margin, while it is expected to generate one-off cost with no cash impact of around 18 million euros in the first quarter of 2026, related to the accounting effects of the reclass to the income statement of cumulative negative amount of exchange differences previously recognized in the equity. Secondly, since January, an agreement with an insurance company in the U.S. managed care business was terminated, as we received progressively significant requests for price reduction that were not compatible with sustainable profitability over time. The recurring discount dynamics being requested would have led to a structural margin compression in a context of decreasing volumes in mature segment with limited growth prospects. This contract had a marginal impact on the group's total revenues in the region of 1%, and no one-off are expected to the termination of this agreement. Of course, we continue to operate in the insurance segment, now with a more diversified and selective portfolio characterized by different profitability profiles. Moving to slide 6, we have a look at the group profitability in full year 2025. Revenues grew 1.7% at constant FX, with flat organic growth reflecting a significant improvement in the second half of the year, despite the strong comparison base of 7% growth at constant FX in 2024 versus 2023, and the global market demand still below historical level. In particular, the U.S. private market was flat in 2025, primarily due to the negative performance of the insurance segment, while the European market reflected the low consumer confidence. M&A contribution was 1.7%, reflecting the acquisition of 250 locations and the closure of around 160 clinics, together with the substantial rationalization of the non-core wholesale business in China within the Fit for Growth program. FX was a significant headwind of -2.3% due to the appreciation of the euro versus the Australian, US, and New Zealand dollars, bringing the growth at current FX to -0.6%. Adjusted EBITDA came in at 540 million euros, with margin at 22.6%, 90 basis points below the previous year due to the lower operating leverage, the dilution effect of the growth of Miracle-Ear direct network in the US, the less favorable country mix in EMEA, and the higher marketing investment to further strengthen our distinctive assets. Moving to slide 7, we have a look at our financial performance in Q4 2025. Revenues were up 1.4% at constant FX versus Q4 2024, with organic growth at 0.6% and back to positive territory in all the 3 regions, although still reflecting the global market demand below historical growth levels. M&A and perimeter change contribution was +0.8% due to the acquisitions as well as the implementation of the Fit for Growth program. FX was a material headwind of -3.3%, increasing throughout the year. Adjusted EBITDA was 145 million euros, with margin at 22.3%, 90 basis points below prior year due to the lower operating leverage, the growth of Miracle-Ear's direct retail, and the higher marketing expenses. Moving to slide 8, we have a look at EMEA performance. In the quarter, revenue grew at constant FX by 1.6%, with organic performance at +0.4%, improving sequentially. In this context, we posted a strong and above-market growth in France and a solid organic growth in Spain, while Germany was in negative territory. M&A and perimeter change was +1.2%, reflecting M&A mainly in France, Germany, and Poland, and selected closures in France, Germany, and Spain. Adjusted EBITDA was 107.5 million, in line with Q4 2024, with margin at 24.6%, 40 basis points below Q4 2024 due to lower operating leverage. In the full year, revenue growth was +1.5%, with organic performance at -0.6% and the M&A contribution at +2%. Adjusted EBITDA was circa 430 million euros, with margin at 26.6%, 70 basis points below last year. Moving to slide number 9, we have a look at the performance in Americas. Revenue growth in the quarter was +2% at constant FX, while FX headwind was a significant -9.9%. Organic growth was positive for +0.9, thanks to the strong performance of Fiscal Year direct retail, despite the very high comparison base with double-digit organic growth in U.S. in Q4 2024 and a slightly negative private market in the U.S. due to the underperformance of the insurance segment. M&A and perimeter change was positive for 1.1%, reflecting the acquisition in the U.S. and some selected closures in the U.S., Canada, and Mexico. Adjusted EBITDA was 33.8 million euros, with margin at 26% versus 26.8% last year, due to the growth of Fiscal Year's direct network in the U.S. and the lower operating leverage. In the full year, revenues were up 4% at constant FX, driven by a solid and above-market organic growth despite the remarkable 2024 comparison base. Adjusted EBITDA was 116.4 million, with margin at 23.5%, 150 basis points below prior year for the reason I just mentioned. Moving to slide 10, we have a look at Asia-Pac performance. In the quarter, revenue performance was -0.3% at constant FX, reflecting +0.8% organic growth, improving 270 basis points over Q3, despite the soft underlying market due to lower consumer confidence. In this context, we posted a solid and above-market performance in Australia, which more than offset the negative performance in New Zealand and China. M&A and perimeter change was -1.1%, reflecting the carryover from the implementation of the Fit for Growth program. FX headwind was a significant -8.4%, driven by the depreciation of all the regional currencies versus the euro. Adjusted EBITDA reached 20.9 million euros, with margin at 24.4% versus 25.4% last year, due to a lower operating leverage and higher marketing investments. In full year 2025, both organic performance and perimeter change were flattish, while FX was a headwind for 6.4%. Adjusted EBITDA was 85.9 million euros, with margin at 24.9%, 130 basis points below 2024 due to lower operating leverage. Moving to slide number 11, we appreciated the full year income statement. In 2025, total revenue came to 2.4 billion, an increase of 1.7% at constant FX versus prior year. Adjusted EBITDA was 540 million, with a margin at 22.6%, 90 basis points below 2024 for the just mentioned reasons. D&A, excluding PPA, were at 259 million versus 252 million last year, increasing around 7 million in light of the investment in network, digital transformation, and innovation, thus at a less pronounced growth versus the growth recorded in the previous year. This led the adjusted EBIT to 281 million versus 314 million last year. Net financial expenses amounted to 63.7 million versus 59.2 million in 2024, primarily due to the interest on higher net financial debt and interest on lease liabilities following the strong M&A and network expansion. Tax rate posted a 70 basis points increase versus 2024, leading adjusted net profit at around 159 million versus 188 million in 2024. Moving to next chart 12, we see the profit and loss evolution in Q4. Total revenue came at 652 million euros, an increase of 1.4% at constant FX versus prior year. Adjusted EBITDA was 145.5 million, with margin at 22.3%, D&A, excluding PPA, decreased by around 6 million, leading the adjusting EBIT to 82 million, with margin at 12.6%. Net financial expenses were unchanged year-on-year at 15.5 million, leading profit before tax at around 67 million. Tax rate ended at 25.6%, leading adjusted net profit to 49.5 million versus 53.8 last year. Moving to slide 13, we appreciate the cash flow evolution. Adjusted operating cash flow after lease liability was in the period equal to 428 million, 28 million below the 456 achieved last year. Net CapEx decreased by around 30 million to circa 117 million, leading adjusted free cash flow to 174 million euros. Net cash out for M&A was 62 million versus the exceptional level of 193 million in 2024. The cash out for share buyback program was 108 million euros. NFP ended slightly above 1 billion after strong investment for over 350 million euro in CapEx, M&A, dividends, and buyback. Moving to chart 14, we have a look at debt profile trend and the key financial ratios. As mentioned, the net financial debt ended slightly above 1 billion, with liquidity accounting for 310 million, shorter debt accounting for around 365 million, and medium long-term debt accounting for around 990 million. Following the IFRS 16 application, lease liability were around 486 million euros, leading the sum of net financial debt and lease liability to 1.53 billion. Equity ended up at around 1 billion, mainly due to high FX translation differences at around 80 million euros, dividends, and share buybacks. Looking at financial ratios, net debt over EBITDA ended at 1.92 versus 209 in September and 163 in December last year, after the strong investments in CapEx, M&A, share buybacks, and dividends. Net equity over debt ended at 1.05 times. I will now hand over to Francesca for some comments on our sustainability path during 2025.
Thanks, Gabriele. Let's now discuss our further significant step up in our sustainability agenda. First, in March 2025, we published our first sustainability reporting in full compliance to the new CSRD requirements and ESRS standards. In the next weeks, we will publish the 2025 consolidated sustainability reporting. In 2025, we reached important milestones in our climate strategy. We obtained SBTi validation of our climate targets, we reduced our total emissions by 14%, and increased the share of energy from renewable sources to 83%. During the year, we also focused on our most important asset, our people. In 2025, we delivered around 600,000 hours of training, confirming our constant attention to skill development and professional growth. This commitment, together with other important initiatives, enabled us to obtain the Global Top Employer 2026 certification, an excellent recognition awarded only to a small number of organizations worldwide. Finally, we continued to conduct ESG assessments on our direct and indirect suppliers and continued to successfully integrate our sustainability targets within our financial strategy. Only in 2025, we subscribed 5 new ESG-linked credit facilities for a total amount of 400 million euros. We look, therefore, forward to our journey toward an even more sustainable company. With this, I leave the floor to Enrico for the outlook slide.
Thank you, Francesca. So we have now reached the final slide of today's presentation. While the market growth in 2025 was below historical averages and our initial expectations, we executed several meaningful initiatives to accelerate future revenue growth and to structurally enhance profitability. Looking ahead to 2026, starting with the market outlook. In Europe, after 3 consecutive years of growth below historical levels, we expect a gradual normalization. In the United States, we anticipate a recovery supported by an easier comparison base and a more positive private market environment. As a result, we foresee a gradual improvement in the global market demand, now expected in the region of +3%. In this context, we aim to outperform in each of our individual key markets, with organic growth showing solid progressive improvement compared to 2025, driven by better market conditions, the initiatives implemented over the past year, and the benefits of our marketing investments. On profitability, we aim to deliver a material improvement, supported not only by a more favorable market environment, but also by the continued execution of our Fit for Growth program, whose results are expected to be strong and already visible in the first part of this year. With that, we thank you for your attention, and we are now happy to take your questions.
Thank you. This is the Chorus Call conference operator. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. To remove yourself from the question queue, please press star and two. Following some feedback received, we kindly ask everyone to limit their participation to a maximum of 2 questions to ensure that all participants have the opportunity to engage. In the interest of time, please keep to a single question format so that all analysts have a fair chance to ask their questions. Thank you for your cooperation. The first question is from Andjela Bozinovic, BNP Paribas. Please go ahead.
Hi, good afternoon. I hope you can hear me well.
Yes.
My question is on the guidance. Can you maybe help us understand the guidance a bit better? So on revenue growth, you expect the market to grow at 3%. And what level of outperformance should we assume? And given the divestitures you have announced, can you confirm that the base that we should base our assumptions on is lower? My math points to around 3% lower base, but any feedback here would be great. And also on the margin guidance, you're calling out for the high end of 150 to 200 basis points improvement from Fit for Growth. Can you update us on the phasing between 2026 and 2027 of this? And if you can share any indication of the quarters in 2026, and should we assume any operational leverage on top of it for the margin improvement in 2026?
Okay. So let's start with the outlook on revenue. I think that we have provided you with all the different key drivers for our 2026 outlook. In particular, as said, we expect a gradual improvement in the global market, and which is an improvement that we see both in the EMEA region, but also in the US. As said, also, we aim to overperform in each individual market, as we did also in 2025. What I mean is that we are pretty confident that in all our key individual markets, like in Q4, like in Italy, or in France, or in the US, we have outperformed the market, and therefore we have not lost share. On the contrary, we believe that in the majority of the key markets in which we operate, we have gained share. Of course, we are not guiding today on the revenue per se, but we are saying that the goal for us is to overperform in each individual market, and of course, the overall result will depend also from the different growth rate that we will see in these markets. Then, on the top line, of course, you should expect the effect of the divestiture of the UK. You should expect also the effect of the termination of the contract in the US. You should expect also some carryover of the Fit for Growth initiatives that we have, I think, shared on the charts. But you should also add on top of the solid organic growth that we envisage, you should also add a positive contribution coming from M&A. In particular, as you know, in 2025, we have slowed down our M&A investments. This mainly because we wanted to focus all our markets, all our organization on the execution of Fit for Growth, which is going very well, and I'm very happy about how our organization have implemented the different streams. So we are now looking at basically complete the vast majority of our activities in terms of Fit for Growth in the market in the first half of 2026, so that we wanted to restart with M&A, let's say, starting from the second quarter of this year onwards. So basically, plus and minus should be more or less offsetting each other in terms of, let's say, M&A or perimeter change, and then you should expect the growth coming mainly from the organic growth, which, as I said, is expected to be definitely improving versus last year and to improve solidly versus 2025. With regards to the profitability, for now, we are not guiding on a specific target for 2026. We are guiding on our Fit for Growth program, which, as I said, is progressing extremely well. Very happy. You should see the benefit of all the 4 streams that we have highlighted in our chart. So the network efficiency enhancement, the back office efficiency, the cost containment program, as well as the strategic review of all our business segments. So that we expect already a strong contribution coming from Fit for Growth already in 2026 and in the first part, I would say, of 2026.
Thank you. Operator, can we move to the next call as we have a long queue? So again, in the fairness to everybody, please keep to 2 questions maximum. Thanks.
The next question is from Niccolò Storer, Kepler Cheuvreux. Please go ahead.
Thanks. Good afternoon.
Good afternoon.
So my 2 questions. The first one is on possibility of exiting other countries. Do you think that after the UK you are done, or should we expect something else? And also possible to see further disengagement from the managed care in the US, or we are done with this contract termination? Second question is on profitability, and maybe if you can help us understanding profitability evolution net of Fit for Growth contribution. So maybe upon which growth level should we expect margin expansion in 2026? And linked to that, I saw a lot of non-recurring costs on 2025 adjusted EBITDA. If you can comment a bit on those. Thank you.
Yeah, absolutely. So with regards to the first question, so basically, no decision, no other strategic decision or step has been formalized or taken, I would say. But of course, we want to build a much stronger profitability profile. We want to invest where we have, let's say, the best opportunities to win, which means where we have strong brands, where we have strong networks, etc., etc. With regards to managed care, now we have a much more, I would say, diversified client base, which make us much more comfortable also looking forward. With regards to the profitability, I would say that you should expect a significant contribution from, as I said before, from Fit for Growth already in 2026 and also in 2027. Of course, the profitability increase will be also function of the organic growth and therefore of the operating leverage going forward. With regards to the last part of the question and therefore the EBITDA adjusted, I would leave to Gabriele that can give you more colors.
Yeah, absolutely. So it's related to some different topics. Fit for Growth, as you can imagine, is by far the most important. I mean, as Enrico was mentioning, we are ahead of the plan, and so, I mean, we started with the cost related to the closure of the shops and the optimization of the back office. A second important item, during 2025, we wanted to have an homogenization and the standardization of the way we take the inventory reserve across the different countries. So, I mean, it was the first year in which we have a common policy across all the 25 countries where we operate. And this basically led us to an adjustment in terms of inventory reserve. We also had a couple of topics to be addressed coming from the past, one in the US and one in Australia. Apart from these four buckets, I mean, normally we put here the cost related to the integration of some M&A. So during 2025, but also during 2024, as you can see from the comparative, basically there are the costs related to M&A especially. These are, I would say, the five buckets. It's of course something that we do not expect is going to happen by cash point of view in the coming years.
Next question, please.
The next question is from Julien Ouaddour, Bank of America. Please go ahead.
Thank you for taking my questions. Good evening, everyone. So I got to stick to two. The first one is, I mean, I just want to try to understand the organic growth there. So it seems that the global hearing aids market was growing, I mean, roughly around 2% plus in 4Q. You reported 0.6% organic growth in the quarter. I mean, you said that you gained share in key markets. Does it mean that you're losing shares in all the markets on a same-store basis. I just want to reconcile basically your performance and the market growth, and how can you basically be back to grow again, at least in line with the 3% market growth in 26? That's the first question. The second one is on Amplifon Hearing Healthcare within your U.S. business. Could you remind us how big it is? And then, I mean, following the termination of one contract that you announced, could you just consider maybe exiting more? As I imagine, I mean, price pressure is just happening everywhere, or maybe even exiting completely managed care. I mean, is it something that you consider right now? Thank you.
Well, I will start with the second question, which is a definite no. What I mean is that we are not planning at all actually to exit managed care. Actually, we have now a much more solid business, I think, because it is built across many different clients. And perhaps to have one big client, of course, would have led to a situation where the kind of price pressure that we received was not anymore compatible with our targets in terms of profitability. So today we are definitely much more, let's say, comfortable with the kind of margin profile that we have got across many different smaller clients, where we can definitely have a much better profitability profile. So we are not planning to reduce further. We are not planning at all to exit Amplifon Hearing Healthcare. Actually, we have a renewed effort to grow there, but perhaps in smaller accounts with a different margin profile, focusing on the quality of the service, and therefore with, let's say, more positive prospects of profitable growth. Then, with regards to our organic growth in Q4, yes, I mentioned that the global market actually we estimate to be slightly positive, but we have to, and I mentioned also that we are pretty confident according to the info that we get, which of course have some degree of, let's say, variability because they are selling data, etc. But we are pretty confident that we have gained share in basically all the major markets in which we operate. I take you, for example, one market which was Australia. Australia in Q4 was pretty negative, mid-single digit negative. We were positive. So the difference between our organic growth and the growth that we reported is mainly due to the market mix. For example, in Q4, the UK market was positive, which unfortunately for us was a very small market. But also in terms of channels, as far as I understand, NHS was very positive. We do not operate in the NHS. So there is a mixed effect, which we expect in a way to improve in terms of mix in 2026. Also in consideration that some effects, like for example, we mentioned in particular in Q2, the anniversary of the COVID in a couple of very important markets for us, like Italy or Spain. In 2026, we should not have this kind of negative effects, and therefore we see these markets performing better than in 2025. So the difference is mainly related to market mix, but as I said, if I look at France, we are very according to the data that we get, we are very confident to have gained share. If I look at Australia, I said, Also in the U.S., actually, the market was slightly negative, and we were slightly positive. So even in Spain, we have posted solid growth. So we are I think, gaining share in the different individual markets. The mix of the market was not very favorable to us, but we expect this trend to change already in 2026.
Perfect. Thank you very much, Enrico.
Thank you.
The next question is from Domenico Ghilotti, Equita. Please go ahead.
Good afternoon. Two questions on my side. First, I'm trying to understand the European performance because I was expecting more sizable contribution from France. So it's fair to assume that Europe was down if you exclude France. And on the expected recovery, I'm trying to understand if you see signs of market recovery on the funnel, for example, or on the engagement with clients. So what is driving your confidence, given also the fact that consumer confidence is still very depressed if I look around?
Yeah. So with regards to France, in Q4, according to the data that we get, the market was up double digits. However, this is volume growth, whilst in value terms, you should reduce this number at least by 2 or 3 percentage points. Then, with regards why we are envisaging a better market in 2026, I think that there are some elements that weigh on 2025 which are going to disappear. It is true what you said, but I think that in Italy and in Spain, in Portugal, the anniversary of the COVID had a significant impact, definitely in Q2, but also a small impact also in Q4. You may recall much smaller impact also in Q4. You may recall also the lockdowns in Q4, etc., etc. And these kind of factors, of course, are not going to be there anymore. Actually, we should see the pickup, the anniversary of the pickup that we have experienced in these markets in 2021. So I expect this market to perform better also on top of an easier comparison base. In the U.S., if we take another very big market, the main driver for the poor performance of the U.S. market, which ended at the end of the year with basically zero growth, was the insurance channel, which, as I said, was basically related to some big insurance scaling back some benefits plans, and probably on the commercial side also there was some cost cautiousness from employers that may have played a role. I think that now this kind of negative performance of the insurance channel should soften. What I mean, we expect a better insurance market in 2026. So I think that in 2026 we had some key factors which affected some of our key markets and which are not should not be there anymore in 2026.
Thanks. Next question, please.
The next question is from Veronika Dubajova, Citi. Please go ahead.
Hi, and good evening. Thank you for taking my questions. Hi, guys. I just want to circle back to sort of your comments around outperformance in each of the markets. And obviously, Enrico, I appreciate we get volume data, you're looking at value, we don't have country-level information, we only have regional information. But just looking at your growth in the Americas, if I strip out Argentina, it seems you're underperforming the market. If I look at Europe, it seems like you're underperforming the market. Can you maybe talk a little bit?
I didn't get to this point about what you mentioned Argentina.
know that if I look at the Americas and I remove Argentina, it looks like the U.S. is down in a flat market for you. If I look at Europe, obviously, you seem to be putting up much lower growth rates than the manufacturers are in Europe. So I'm just trying to understand where this confidence of outperforming the market is coming from. And I guess if you can give us a little bit of reassurance that that is indeed happening, because looking at your performance, and it's not just this quarter, unfortunately, right? It's now been a trend for a couple of quarters where certainly from the data that we see from the outside, it does look like you are not growing in line with the market. And have you done some work to sort of absolutely verify that you are growing in line or ahead of the market? Or is there something that needs to change in terms of lead generation, et cetera, that you need to address? I know it's a very long question, but it's sort of one that's top of our mind.
It's very clear. It's very clear, and I think that it's a very important question, but I would answer with a definite no. What I mean is that we are absolutely convinced that overall we are performing at least in line with the market, if not better. What I mean is that if you take, for example, as I said, Australia, according to the official data, Australia in Q4 was very, very negative, between 5-6% or even more than that. We had a positive organic growth. If you take France, as I mentioned, the market growth in France was double digits, but we performed in terms of units better than the market, thanks to all the work that we did last year, et cetera, et cetera. If then you take also the U.S., in the U.S. we were slightly positive in a context of a market which was, again, according to HIA data, slightly negative. And this is a data for Q4, as I said, is related to sell-in, but also in the full year, the U.S. market growth was basically zero, as I said, mainly driven by the insurance segment. So no, I'm very confident that we have at least held our share. I mentioned in the past that we were not performing in line with the market in Spain, but now we see the results of all. We start to see the results of all our work, of the work that we have done, the new management team has done, and in fact in Q4 we posted a solid growth. So we are pretty confident that definitely we are not losing share. Of course, as I said many times, there is a mix difference if you compare our performance with the manufacturers, both in terms of markets. As I said, for example, the UK for us was a very small market, or in terms of channels, which, as far as I understand, are performing very well, like the NHS or performed very well, or like VA.
And Enrico, can I just ask, you didn't mention Italy, which is obviously your single biggest market in Europe. How are you performing in Italy versus the market?
In the market, I'm absolutely sure that we performed at least in line with the market, if not better. But as I said, the market in Italy, especially in Q2, I mean, if you look at the full year, was very negative for the anniversary of the COVID in 2020, but also in Q4 was not really very positive. So we are expecting a much better market in Italy in 2026 for the anniversary of the pickup in demand that we had in 2021. So overall, we expect a more favorable mix of market in 2026.
Got it. Thanks so much.
I'm absolutely convinced that specifically to Italy, we have not lost the share.
Can we move to the next operator?
The next question is from Oliver Metzger, ODDO BHF. Please go ahead.
Yes, good afternoon. Thanks for taking my two questions. The first one is general market specific one. So your expectations of 3% for 26 are still below the historic growth level. The base in 25 is super low. Historically, we saw potentially the weakest market year in decades. But normally there was always a return to the mean. Now expectations have lowered. So what has changed in your view of the hearing aid market? That's question number one. And question number two, you talked a lot about 25 and the regional performances, and you gave a quick hint on US for 26. But can you also give a more profound view about the different regions? Which performance do you see for them, and what are the drivers? Thank you.
So thank you for the question. So with regards to the first question, the 3% market, I see that some of our suppliers have even a more positive view on the total market. I think that 3% is a fair assumption for 2026, also in consideration that we can't say that the current macroeconomic and geopolitical environment has no effect at all on our sector and on our patients. As I said, we expect a better market in 2026 because in 2025 we had some material effect on some key markets for us. I mentioned the US. I mentioned the decline of the insurance channel in the US. I mentioned Italy. I mentioned Australia, etc., etc. So we expect a better market also on the basis that in 2025 we had some specific events, and that also from a comparison-based point of view, we should be in a better place in 2026. With regards to the growth in 2026 by region, from an organic viewpoint, we expect to improve our organic growth, I would say, across the different three regions, with not a specific region going much faster than the others.
Okay, thank you.
The next question is from Martini and Rula, Jefferies. Please go ahead.
Hi, I hope that you can hear me okay. I would have two questions, please. The first one is on the guidance itself. It's quite unusual that you guide in such a qualitative manner, so I would like to understand just the rationale behind that. And still on that, should we understand that the level of visibility you have on the expected market recovery is low, given you have not quantified what we should expect for you to post into 2026? And I would probably leave you some time to answer that question before asking the second one.
No, well, in terms of outlook, I think that we have given you many different indications. Of course, it's early days. What I mean is that just 2 months of the year have ended, and you know very well that also March is a very important month. So we wanted to see also how we will end Q1 to give you maybe a better granularity at the end of the Q1. I think that this is pretty fair, and in consideration of the fact that you know very well that I mean the market in these days are not extremely predictable, but we assume that we can give you more granularity at the Q1 results, when at least we have the visibility on the Q1 actual and also April sales. So we prefer to give you this kind of more visibility at that time. But anyway, I think that we have given you also very, very precise indications in terms of what you should expect in terms of market growth, what you should expect in terms of M&A or perimeter change. So I think we have also said that we expect to improve materially our profitability already in 2026. So I think that we have given a lot of different indications that could be useful for your models.
Okay, thank you. And on the second question is about just getting some insights on your regional growth expectations that are baked into the guidance. And also, I would like some insights on the phasing as well. And if you could do a bit of a focus on EMEA and talking a bit more about how do you think about France and Italy specifically for 2026, knowing that, as you said, Italy was apparently very negative, the market was very negative in 2025, and knowing as well the fact that in 2026, and more specifically on Q2 2026, we should see the annualization of the strong growth that we've had in France.
You are right. What I mean is that definitely in Italy, we expect a much better market in 2025 because we will not have the effects that weigh on 2025 due to the anniversary of COVID. Actually, we should have more returning customers coming from the increase of that we experienced in 2021, basically starting from the Q2, I would say, or first months of 2026. With regards instead to France, I think that you should expect the continuation or anyway good performance of the French market due to the anniversary of the reform in the first 3-4 months of the year. Then, of course, we will be anniversarying the increase that we had in the market in 2025.
Next, please.
The next question is from David Adlington, JP Morgan. Please go ahead.
Hey guys, thanks for the questions. First up, I just want to make sure we're all on the right page in terms of the base that we're working off in terms of both the sales and the EBITDA. So the total impact of the UK disposal, managed care, and the Fit for Growth disposals, both on the top line and also EBITDA, please.
Yeah, well, so in terms of top line, as I said, you should expect more or less basically a net impact of the divestiture of the UK, the managed care, etc., to be offset, to be almost offset entirely from our M&A. As I said, we are planning to restart, I would say, our M&A effort, the bolt-on M&A effort, basically starting from Q2. As I said, in the second half in particular of last year, we have slowed down significantly our bolt-on acquisitions because we wanted to focus our organization on the Fit for Growth program, but we are ready to restart as soon as we have completed this program. We thought that it would not make any sense actually to continue to acquire shops in a moment in which we were rationalizing our network. With regards to profitability, as I said, we are not now giving you a specific number, but definitely we expect a material improvement in 2026. We already started to see the benefits of Fit for Growth, which should give the full benefit in 2027, but with material impact already in 2026.
Okay, thanks.
The next question is from Susanna Ludwig, Bernstein. Please go ahead.
Hi, good evening, and thanks for taking my questions. I have a question in regards to the Fit for Growth program savings. Do you expect the full savings to drop down to margins? I know you also mentioned it will be a function of organic growth. I guess said otherwise, what level of organic growth do you need to sort of sustain margins at current levels and avoid sort of deleveraging impacts?
No. Well, thanks to Fit for Growth, we are envisaging to grow our margin even if, with zero organic growth. So what I mean is that this is a program that, thanks God, we have initiated almost 1 year ago, and is going to have a positive impact already this year. So what I say is that if on top of Fit for Growth, if we see a good operating leveraging coming from a good organic growth, of course we can also have a better profitability beyond the Fit for Growth. So let's say that.
I guess just to be clear, even if you have flat organic growth, you still can sort of have 150 to 200 basis points of margin expansion due to the Fit for Growth improvements.
Let me say that the 150, 200 basis points is the impact of Fit for Growth. Is the impact of Fit for Growth per se. Absolutely.
Okay, thanks.
We have one more question from Giorgio, please, operator.
The next question is from Giorgio Tavolini, Intermonte. Please go ahead.
Hi, good evening. Thanks for taking my questions.
Hi.
The first one is on M&A. After exiting the UK, if you are looking to enter new geographies to reduce the exposure to EMEA, maybe focusing more on strengthening the US direct to retail and so on. The second one is on China contribution in 2025. I saw you are also planning a rationalization of non-core wholesale in China, so if you can clarify. And the very last one, if I may, is on the Fit for Growth. Should we expect benefit to be mostly embedded in each region profitability or also in terms of lower central costs? Thank you.
Thank you for the question. So in terms of new geographies, no, we have no plan to enter new geographies. Of course, as you rightly pointed out, for sure, US will be our first area of focus in terms of growth and in terms of M&A. So for sure, we are envisaging a situation where we will restart bolt-on M&A in the US in 2026. With regards to China, in reality, the decision to exit the wholesale business we shared already in Q1, so it's something that has been already done basically last year. So that is something that is already on the base of basically almost all 2025. In China, we see the market stabilizing, so we also there see a better environment in 2026. With regards instead of Fit for Growth, can you please remind me which was the question on Fit for Growth? Better cost. Yes, of course. Absolutely. For sure, we are looking at the back office, not only in the market, but also in headquarters. So both in the corporate headquarters, but also in the headquarters of the market.
Many thanks.
Thank you.
Thank you. So we have taken all the questions. This concludes today's call. Thank you all for your interest and attendance. We kindly ask operator to disconnect.
Thank you so much, everyone. Thank you. Bye.
Ladies and gentlemen, thank you for joining. The conference call is now over, and you may disconnect your telephones.